we're big investors in alternatives as a team, as a business. The big challenge we have when it comes to the South African market is that underlying funds that we access need to be Section 65. Now, this is a challenge. There aren't a lot out there that would fit what I call true kind of alternatives. What do we like? We like specialist property. That's not your, I would say, your kind of typical global listed property companies. These are very specialist property operators. Similar on the infrastructure side. We like private debt. We like private equity. We also like some novel asset classes that emerged in recent years. Things like music royalties, you've heard us speak about, aircraft leasing, and so on. Alternatives have been a great area for us so far this year. They've returned about 16% in dollar terms. Is it time for alternatives today? I think it could be. Look, people are always debating. This is what I'm always asked. They're always debating things like US equity valuations. Is the US expensive? Yes, I'd say it's expensive, but it's not that expensive. S&P 500, you may know, it's on a P today of about 24, 25 times. That compares, I think, to fair value at closer to 20 times. So it's a bit expensive, but I don't actually think that kind of question is that exciting. So what instead is exciting, I'd say alternatives right now. And why? Well, because they're incredibly inexpensive, cheap in certain areas. So S&P, that's on a multiple of about 24 times. We're able to buy some of these alternative ideas. We have at low double-digit PEs, even sometimes at single-digit PEs. So that, I would say to you, is where we should really get excited rather than debating the merits of the Mag 7 over and over again. Give you an example. We bought an infrastructure company called BBGI. We bought it on about a multiple about 14 times. That gives you a yield of about 7%. That yield is linked to inflation, so don't worry about the inflation outlook. That yield is very high quality, we're very confident we're going to get paid that yield. And look, I would happily have sat there year after year and just ticked that 7%, call it a coupon, it's a dividend in fact, but just tick that each year. That's a fantastic investment. What in fact happened was other investors saw that really was too cheap to be true, and so the company gets bought out at about 20% above the prevailing price at the time. So that's just an immediate 20% return for us by virtue of accessing some of these really interesting ideas. I mentioned music royalties a moment ago. Hypnosis, company we owned for several years. Again, we bought it on an average multiple of about 14 times, so a yield of upwards of 7%. Again, we liked that company. So did other people eventually. They came in, bought it out, and that was at a 32% uplift to the share price at the time. So this is why I say when I'm quoting these kind of numbers, these are genuinely great returns. These are things that I think we should get excited about. I think most asset classes out there at the moment are pretty reasonably valued. I think the alternative space, there are still some areas there that are genuinely very cheap and mispriced. We access these things as a team. I've already said it is more difficult to access them currently in the model portfolios, but we are hoping to have these kind of ideas packaged in a Section 65 fund very soon. So please look out for that.